Okay, so in the world of finance, you've got these two powerful tools, call options and forward contracts. And on the surface, they can seem pretty similar, but really, they boil down to one simple question. And that's exactly what we're going to untangle today.
So let's just frame it like this. When you enter one of these agreements, are you giving yourself a flexible choice you can make, or are you giving yourself a firm command you must follow? Honestly, understanding that one distinction is the key to unlocking how both of these instruments work.
All right, first up, let's dive into the world of flexibility, the world of choice. We're talking about the call option.
Now, the definition here is super important, but I want you to zero in on that key phrase, the right, but not the obligation. Think about what that means. If you buy a call option, you've essentially bought yourself the opportunity to do something. You've locked in the chance to buy an asset at a set price. But here's the kicker. Nobody can force you to actually go through with it. You are completely in the driver's seat.
Okay, that's the theory. Let's make it real with an example you've definitely heard of, Apple stock. So imagine you buy a call option for Apple. This contract gives you the right to buy 100 shares at, let's say, a strike price of $300 a share. Now, if Apple stock suddenly soars to $350, you can exercise that option, buy the shares for your locked-in price of $300, and hey, you just made a nice profit. But what if the stock tanks and drops below $300? Well, you just walk away. You let the option expire worthless. You only lose the fee you paid for the option itself, but you're not forced into a losing trade. See? That's the power of having a choice.
So we've talked about choice. Now let's completely flip the script and talk about commitment. This is the world of the forward contract, which is all about the binding promise.
You see it right there in the definition. The absolute most important word here is binding. Unlike an option, a forward contract is a two-way street. It's an obligation for both people involved. When two parties sign this thing, they are locked in. There's no backing out. One person must buy, and the other person must sell. Period.
A classic example here is with something like gold. So picture this. A gold miner wants to lock in a price for their future production, and a jewelry maker wants to lock in a price for their raw materials. They agree to a forward contract. In 6 months, they'll trade 100 ounces of gold at exactly $2,000 an ounce. Now, when that day comes, it makes no difference if the market price for gold is shot up to $2,500 or plunged to $1,500. It doesn't matter. The deal must go through at $2,000. Both sides are obligated. The choice is gone, but it's been replaced with total certainty.
All right, we've looked at them one by one. Now for the main event. Let's put them side by side. This is where the difference really pops.
Look, if you walk away with just one thing today, this is it. A call option gives you the right to buy. A forward contract gives you the obligation to buy. It's kind of like the difference between having a restaurant reservation that you can cancel versus buying a non-refundable locked-in plane ticket. One is flexible, the other is set in stone.
And we can break this down even further. So call options, they're standardized. They trade on big public exchanges just like the stock market. Forwards, on the other hand, are totally different. They're private deals negotiated directly between two parties. We call that over-the-counter, or OTC. And because they're private, they can be highly customized to fit very specific needs, which is why they're so common for commodities like oil or grain, while you see options on everything from stocks to bonds.
Okay, so we get the what. We understand the differences. But what about the so what? I mean, why do these financial tools even exist in the first place? Why does any of this matter?
Well, even though they're so different, they're both used for two main reasons. The first is hedging, which is basically a fancy word for protecting yourself against risk. Think of that gold miner who just wants to lock in a profitable price. The other reason is speculating, which is just what it sounds like, betting on which way you think prices are going to go. That's our Apple investor who thinks the stock is about to take off. The choice between a right and an obligation just gives people different ways to manage risk and place their bets.
And that brings us right back to our original question. Ultimately, choosing between an option and a forward all comes down to what you're trying to achieve. Do you want the flexibility that comes with a right, that power to walk away if things go south? Or do you need the absolute certainty of an obligation, a deal that you know is locked in? It's a fundamental question of risk versus reward. And at its heart, it's about choosing between a choice and a command. Thanks for tuning in.